Well, let's get started. For everybody on the Facebook group, or if you joined us directly on the Zoom chat, welcome. It's our we're getting closer to the end of the series we started with Ron. Again, want to thank Ron for being part of this, helping us out, provide some of your wisdom to many business owners. I've connected offline to a lot of people based on your knowledge and your guidance, and we able to actually have some success stories from that. So we're really happy for that. In addition to that, I wanted to kind of, for those who don't know me, introduce myself real quick. Every single time we do this, I introduce myself. So hopefully, for anybody that's watching you'll know who I am. Basically, my name is Edgar Martin. I used to be a banker for Wells Fargo. I quit my job because I wanted to help business owners with not just lending or checking accounts or bank products. I wanted to help them in a more broad way. When it came down to all the stuff I was learning, I wanted to help them on the overall inner workings of a business. And here we are today with Ron, and I wanted him to introduce himself, but at the end of it all, Ron has been a mentor to me for a year now, business consultant, and I love the way that he looks at it from a different perspective when it comes to the marketing side of things, but also the accounting side of things. So with that said, I want Ron to introduce himself real quick for those that don't know us, and we'll get started with our topics of the day.
Sure. Yeah. Thank you, Edgar. This has been a nice job these last several weeks for Collaborative Networks, and the way you've launched it. It's been interesting, and looks like it's off to a great start. My name is Ron Burgess. I'm with Micro Giants, which is a nonprofit mentoring group that we started. It's been a year, and that is kind of a retirement thing for me. And I really enjoyed doing that. So we both mentor new and young businesses, and at the same time we do small business advocacy. So it's been an interesting time to be in the middle of COVID, in the center of this new role. I have been in business for a long time. I started 6 businesses over the years. The first one when I was 20, and then a larger one that lasted for about 12 years in 7 retail stores when I was about 24. Also in the manufacturing business, and have had an internet and marketing design business for 20 years. I started my consulting career when I went to work for a national consulting firm for about 7 years, and I did their new product development. We had about 1,200 specialty retail stores. So I got an opportunity to really get in deep with all kinds of things at that time, developing some new products that were number related products, and merchandising products as well. So that's kind of a real snapshot of what I've done. My interests today, as I mentioned, are just trying to help small businesses. Couldn't be a better time to help small businesses than with all of this going on with COVID. And so happy to be here on the Collaborative Network, helping that process.
Thank you. Yeah, Collaborative Networks, it's evolving. The ultimate goal is simple: help as many people as possible with as much knowledge as possible. So that's where we are here today. There were some conversations that Ron and I have had in the past that I wanted to bring up to the business owners, and we figured we can take today's as an ability to do so, especially starting with one of the topics that we brought up, which was we just speculated of some of these industries that we probably haven't really put too much thought into it. They're going to be affected by the virus, and I feel like that would give us a good start in this conversation. I wanted to go into cash flow as well as into reopening a little bit back. We already brought that up in the past. We have a video on specific an industry. I want to talk about multiple industries this time, and ended up maybe with a little bit of a lending options that where I came from, and we have David Montano, which is also really good, an expert when it comes to lending on especially alternative options. So Maybe let me give David a quick moment, maybe introduce yourselves. I know it's always been Ron and I, but I'm kind of glad to have you here today, David.
Yeah, hi, Dave Montano. I am a licensed broker here in California. I've been in the finance industry since 2004, and I've always specialized in outside of the box type of alternative financing once, loans or loan requests get denied from local banks. That's typically where my clients would call me in and find out. We pick up the pieces of where they got denied, and we also take a look at other alternative assets that they may be overlooking, such as accounts receivables, equipment. There's lots of ways to raise capital within the business. My job is to make sure that they're not getting these predatory merchant cash advances and these high interest loans when there's other options available to them once their bank denies it. So I like to provide that secondary option for them.
Awesome, Dave. Thank you for that. And anyways, so for today, let's get started on the first subjects. Ron, I know you wanted to kind of give us a little bit of bring up the industries that might be affected that we might not even think about are going to be affected.
Yeah, let's do that. Last time, this is a series, and I think this is the fourth now in the series, where we talked about cash flow. And in fact, I'm just going to throw up a couple of slides so that those of you who are watching can take a look at some of those and have something to look at instead of my old face here. So what we started off with is looking at cash flow, and we're going to skim right past this stuff, but just to kind of mention that there are a lot of sources of cash here out of the faucets, and then the bucket has a lot of holes, and what's left, if there is any, can get used by the owner. Unfortunately, a lot of times there are a lot of holes in the bucket, and keeping cash in the bucket is a hard thing to do. So we go through and look at a spreadsheet that is built specifically to look at inputs for cash and outflows for expenses, all inputs, all outflows, so that you can kind of calculate where you're going to be in the future. That's very, very important. Probably number one in terms of staying in business is cash. The other thing we did is we took a look at break-even analysis. And again, you can go back and take a look at the first couple of videos in this series, and you can see more about what we're talking about. Suffice this to say that when we have fixed and variable costs, fixed this line right here, and variable going up with our sales line, which happens to be the black one, this difference here is the margin. And so when you take this line and you push it up, you end up with just a little bit of pure profit. When you hit the break even, you know that you're making money from that point on, and it gets bigger and bigger as your volume goes up until you have to increase your fixed expenses. A break-even analysis is really a key and a much easier tool to use than most people think. Same with the cash flow. And once you determine where your break-even point is, then it really helps you determine, should I go back into business? What kind of volume do I need in order to be able to break even or make a little bit of money? How long will it take me? How much volume will I have to have if I'm going to have to increase my my interest rate because I have to borrow money? Do I need to be up here? Do I need to be up here in order to be able to pay for those costs and, of course, make some money as well? So that's the initial discussion. Then we went through some do's and don'ts as far as opening. We're going to skip past those kinds of things just to say that we looked at several different industries, and we focused a little bit on both restaurants and retail stores. The story is a little bit bigger than that, and we've had more information in the last week. So I thought I would start then at this slide and give you 2 or 3 slides that we covered to give you a little bit of background about what some of the recent surveys are showing in terms of people's attitudes just about life, about business certainly, but about life as well. So you can see from this particular slide that of those who are looking at values and practices and so forth, and uses of business that the people who consider working at home are about 30% more. And so what that means is that even though 57% say they'll work from home about the same as they did before, 30% said that they're going to work from home even more, and only 13% said it would be less. So, you know, that obviously has a lot of ramifications for anybody that has any physical property, works in an office, expects customers to come to a mall, etc. You know, that's kind of the first attitude. Another view at this, when customers were, whether they were fearful of the economic impact compared to their health, 64% said they were fearful for their health. 82 said they were fearful of other people's health. So socially, that's nice to see that people are more concerned about other folks. But at the same time, that's a lot of people. That's a lot of concerned people. So you can see there's going to be a lot of the very tentative exposure outside, despite what the parties we've seen and the beaches, the overcrowded beaches we've seen on the media. That's not happening everywhere. That's happening a few places where cameras managed to find them. As a matter of fact, the media might be overblowing these parties a little bit. I noticed it's in several of them where they were, as they would talk about the story, they'd say, oh, there's no social distancing. But when you took a really good look at the image, it was shot through people at a distance. It looked like they were close, but they were really not that close. So be wary of the media. I think people are not as interested in wild parties face to face as the media would have us believe, and as these particular numbers would indicate as well. 64% are concerned about the impact on their personal job. That's a lot of people worried about their personal job, and 88% are worried about the impact on the economy. So this is pretty impactful stuff. It gets more interesting as we go forward. This is a summary. Sorry, it's just clips out of the Wall Street Journal. We just wanted to kind of talk a little bit about this one. This shows where the worst unemployment is: Hawaii, New Jersey, Nevada, New York, Louisiana. You've seen a lot of these numbers, and you can see who is having the biggest problem with employment. It's not unusual. The higher educations are lower, less than high school, or a little higher, etc. So that's pretty normal. The crowd control is an interesting new bit of research, and that really has to do with what they call super spreading. And this particular chart shows without crowd control, meaning a lot of people in a theater, this is where we're going to be in terms of deaths. With a little bit of control, 50-person limit, it's going to be this. And then with no mass gatherings, it's going to be more like that lower one. So you can see how that's trending. That sort of spells another kind of another dimension. And that really is that big events are really, according to this new research that the Wall Street Journal put out last week, that super spreading events have been researched and found to be the primary problem for the big problems. This morning they released a map showing where all of the big outbreaks are. And it's interesting because they follow this almost identically. There are big ones in Germany, Louisiana, all kinds of things going on due to partying there, which is what they do this time of year down in Louisiana, and a lot of parades and so forth. Washington is a big problem, close to the cities. Skagit County, Blaine County, Indiana. You take a look at the map, and sure enough, in the middle of Idaho, there's a big red blot showing that the events are much worse there. And when they look at SARS and MERS, they find that had to do with super spreading events too. I've been surprised this week, that more people haven't picked up on it. I did see some media talking about it, but it hasn't taken the forefront with a lot of the other sensationalist stories right now. The media is not really bringing us this story as strongly as it feels like, just to me, that it should be, because this is real good, solid research that was reported on by the Wall Street Journal, which happens to be the only newspaper that I actually still trust. So here are some new stats that kind of go along with this that we've added this week. The Harris poll found that, and this has to do with people and their attitudes, that about 15% of Americans say that they would fly a month after the government signals that COVID-19 is abating. Well, they've sort of said that it is, but they haven't officially said, oh yeah, it's on the way down. So we haven't started that 1 month time period yet. Another 16% and 15, if you combine it, say that they'll fly within 3 months. And then about half Americans, 49%, think that they'll be ready to fly in 6 months after the point where COVID is stopped. So you can see that really pushes business on airplanes out a lot. And of course, not only flying, but anything that they would be doing at the other end that's business related. In hotels, 1/5 of Americans, 21%, say that they will stay in a hotel 1 month after the curve flattening, which we haven't gotten to yet. So that's a ways out. 20% more said that they'd stay within 3 months, and 60% said that they will likely not visit a hotel for 6 months. That's a long time. The main point here is, the main point is people are not ready to do a lot of these activities. Edgar, yeah. So comment?
Oh, no.
Okay.
Yeah.
This shows it a little bit in a graphic, so you can here are take a cruise a year or longer. I don't know how your cruise stock is doing, but I know that I don't have any cruise stock at all for a reason, because I felt from the very first time that the people were held on the ship and not allowed to get off, I knew that it was going to take a really long time for people to get used to that and feel comfortable and redevelop trust. This is about gaining trust again. And so that'll take a while for that to happen. It's going to be devastating for the cruise business. I know they'll come back, but it'll take a long time. Flying a plane, as we looked at, 4 to 6 months. Visit a casino, 4 to 6 months. Stay in a hotel. Go to a sporting event. So here is one of those super spreading tools, a big sporting event. In the article, they said that it was not only being close to a lot of people, it was that there might be several people who have the COVID virus, and that all of the touching, hugging, and especially being indoors, so it'd be worse for basketball than it would be for football. But especially when they're indoors, like at a movie or at a concert, that is a place, and you're there for a while, that's a place where the virus seems to actually cause deeper outbreaks, not only bigger ones, but deeper. They tend to get sicker than people who have caught it from an individual, say, giving them a hug outside on the, on the street or something. And so that's why these super events are tough. Already, without knowing this knowledge, that's pretty strong. 4 to 6 months wait, 2 to 3 months to go to a gym class. Another big problem. Throughout this, we've talked about my neighbor who has a gym. He's opening on Monday, but he's going to open at a very small percentage of his capacity, and he's going to continue to lose money for some time. Going out to dinner, 2 to 3 months. I heard that here where I am in Redlands, I heard that we had stores open, restaurants open, and so we thought we'd venture down and see what it was like, see if we could find some lunch yesterday. And the places we looked were not open. They were still doing takeout. We had a great lunch, but we had to eat it on the street, and which was a lot of fun. It was nice just to get out. So 2 to 3 months is what most people are saying. These to host or attend a large social gathering, 2 to 3 months. I'm going to bet that's going to go back up to 4 to 6 months. That's light. Same thing with the movies. Public transit, 2 to 3 months. Greeting people in a handshake, 2 to 3 months. And of course, going to the office from 1 to 30 days. So some of us are just starting to go back to the office now. So that's pretty grim stuff right there. So when we look at another way at sort of just basic industries, big down on cruises and vacations, flying, big problem as we discussed, distance learning of all types going to be way up. A lot of people are going to continue to do distance learning. There are companies that have exploded with this opportunity to offer more courses because they're already in the business. There are a lot of new companies who are entering the space, individual teachers that are doing their own thing online. That is going to really change things. And of course, that is kind of includes what we're doing right here, right now. Zoom meetings, as we know, are way, way, way up from, I think, it was 10 million to 300 million or something like that. It just numbers that are hard to imagine. So, not all of us are going to stop doing Zoom meetings. I love them. I don't think I'll ever stop doing Zoom meetings. I've been doing go-to meetings for 10 years, and never have I enjoyed doing it as much as on Zoom, because I just like the format a little bit better. Super spreading events, way, way down, as we talked about. And then there's this other category, which has to do with real estate, close living, elevators, working close to each other, shopping close to each other, big cities. As we all know, New York is just got problems. And yet Los Angeles, just as big of a city, does not have problems. They're being way too restrictive in Los Angeles, perhaps thinking that something is going to happen like New York City. But the fact is that New York City lives an entirely different way than we do in California. In California, we are in our own houses for the most part. We don't live, we certainly have apartments, but they're not as close as they are in New York by any stretch of the imagination. We get in our own enclosed car, we drive to work, and we get out and we go into our office. Many times our office are in office complexes that have parking close by. Many times you don't even have to get into an elevator. It's an entirely different factor. But those densely packed cities and communities even within Los Angeles, there's some densely packed communities, and people are going to shy away from those. It's beginning to look like people will be very concerned. Same with commuting, getting into an enclosed space, tightly packed with a lot of people. So that sort of changes California's entire plan for creating higher density communities. Some of you are aware that, I know David would be, that the new California zoning laws supersede, I think for the next 5 years, supersede local laws and basically removes local zoning from the local community power. And it means that people can plop a mother's law apartment in the back, house in the backyard if they've got room, and you can't restrict that anymore. It means that you can increase density from 3.5 per acre to 50 per acre, or whatever the numbers are, so that you can override local real estate. Maybe we can talk a little bit more about that with David. So how do we move forward? What do you do? Kind of to summarize this conversation we've had for the last 3-4 weeks. Get that PPP grant if you can. It's been a moving target. We've talked a lot about that. It looks as though it's getting easier to meet the target for the grants to me. And so you guys can weigh in on that. You're experts on that. It looks like it's going to be easier, especially for very small businesses. I've heard the break point is $2 million where the audits begin. So, you know, get it if you can. Really try to get it. Do cash flow and break even. And by the way, I'm working with one account still that needs to be recapitalized. If they get the grant, because they did not have to go out of business, they're an essential business. If they can get that grant and keep that in the business, even by paying payroll, it means they don't have to pay payroll out of their current funding. And therefore, just for that 8 weeks, that would be a shot in the arm that would effectively recapitalize the whole business. There are other businesses that will take advantage of that if they didn't have to close. And that's going to be a real bonus for, now it's not fair. I'll be the first one to say that the way that the federal government distributed the PPP loans and grants was not fair in many, many ways. My own opinion is the bigger the organization, the worse control you have. And we've seen that in this. This is in spades. Despite the good planning, the need for it, I'm not saying we didn't need to do that, but I am saying that the distribution was not very good. So try to get it if you can. Do your cash flow and break even analysis. Add the costs for PPE, personal protection equipment, and increased mod rates. We haven't talked too much about the mod rates, but this is a serious issue. The reason that the mod rates are a problem is because Newsom has basically stated in a new decree that all of the unemployment, let's see, not unemployment comp, but the workman's comp, all workman's comp claims will assume, if they're COVID related, they will assume that the employee got COVID from the business where they work. Automatic assumption. It sounds as though that they will imagine that the employer is at fault until they prove that they are not. This is tantamount to you are guilty unless you can prove yourself innocent, goes contrary to everything that the United States judicial system has ever meant since the beginning. Nonetheless, he is still tending to do that. And until that is tested in court, we're going to go forward with that. And as we start to get COVID cases, we're going to have lawsuits like you can't believe from employees. We're going to have the mod rates. I don't know what that means. Maybe one of you guys do. The mod rate, which is how they calculate how much to withhold for workman's compensation if you're injured. Like roofers is really high, almost like half of the salary, you know, in that range, you know, from a quarter to a half or more. Office workers are very slow, just a very, very low, very small percentage mod rate. It's a very small number for most businesses, but if there is a chance, as the chance for injury goes up, the mod rate can go up dramatically, like 50 times. So if everybody is included in a unrealistic mod rate for COVID virus, then everybody's mod rates could go up. We could see some businesses skyrocket, and well, I know businesses that went out of business because of their mod rate went up in several industries in construction. So that could happen again. So be sure to add all of those new costs into your expenses for your new break-even analysis. Determine how long you can survive without additional funds, and that's what the cash flow is for. Assess your risks to open versus close permanently? Will you be able, does it make more sense based on that assessment to restart your business and then have it pay everything back? Or should you really restart at another time? Try and of course, that has a lot to do with what your risk really profile is. If you have a lot of assets that can be attached or are attached to a loan, that would change your approach on whether or not you would just get out of business, because you're still going to be stuck for that loan. But if you're in a hole and you're going to go into a much deeper hole, there are going to be times when it makes sense because you have a little bit of equity in a house. There will actually be times when it makes sense to walk away. Spend a lot less money personally and the business, save more money, and take on as little debt as possible. Now that seems ridiculous in this atmosphere. You're going to have to take on debt if you haven't been in business. Well, it's the rare business that has been closed for 2 months and maybe opens now or in another month that is going to be able to make it without additional funding. There are going to be some old line businesses that have been around for 10, 15, 20 years that do have a lot of cash, a lot of assets, and they'll be able to make it. But for the most part, as you get started and you go down the road, don't do like the cash poor companies that we're seeing fail right now. Do something different. Save money. Be really careful about how you spend it and take on as little debt as possible so you can survive the next time. Now, this is a one-time black swan event, as they say. So what are the chances that it'll happen again? Well, maybe not very high, but we already had SARS a few years ago. And I'm old enough to remember when we had the Asian flu. I mean, I remember that. And I remember my grandmother talking about the 1918 one. They were really bad. The difference is we closed this time. We've never closed before. So will it happen again? It's hard to say, but there are other events like an earthquake, or what happens if the internet goes down for a month. That'll change the way we do business. Like, can you imagine Amazon not being available right now? Wow, right. Finally, be an individual. Don't follow the crowd. Use experts, but do your own thing. Don't just do like every other business does. And because they are all buying new cars, doesn't mean that once you've been successful, you need to have a new car. You need to be your own person. Think individually, think critically and realistically, and solve these problems, and then start going in your business again and stay as an individual, independent person as much as possible, so that we don't have strings attached to everything that we do, which is going to happen with the loans that we have right now. So that's pretty much it. I have another slide on technology changes in business, but maybe we should pause there for a minute and kind of open it up and have a general discussion about some of these issues that you've got.
Yeah, I'd love to do that. I try to not stop the conversation when I see something, so we could go through your deck and then be able to open it up. But let me see if I can go back and start knocking some of these comments or discussions. And David, feel free to jump in at any minute, man. The biggest thing that that keeps popping up in my head when we talk about all the fear and all the all the business owners trying to figure out a way how to reopen, and industries are affected that the obvious ones are the airline industries and things like that, right? Restaurants.
Yeah.
One of the ones that I'm trying to compare to what would be the equivalent to 2008, and I think this time is going to be the commercial real estate world. You mentioned the fact that The city doesn't, like a general plan on a city, you have to zone areas and things like that. So if you start getting rid of some of those regulations, mostly because there's going to be a lot of vacant land or buildings that are no longer going to be able to use the way that were intended to use just 6 months ago, or not even. And that might be one of the things that people might not be aware of, but some of these big buildings potentially sit on someone's 401k or retirement account, on some sort of, a mutual, like a hedge fund or something, where in turn, if this big, huge mall goes down, that's the little market chain of effects that start happening that causes, well, that didn't affect me, but then you see it get you on the back end when all of a sudden your 401k or your retirement plan disappears. So I can't stop thinking of that scenario being a possibility.
You're quite right there. A lot of us forget that our money, especially our 401ks, are out there in all kinds of stocks, bonds, and further, they're bundled into, as they have been in the past. When we had our 2008 mess, we had an awful lot of real estate secured investments that were bundled together and sold off to people who had no idea what they were, and they were pieces of investments. And as much as we were really, really severely hurt from that, we haven't learned our lesson, because we still have all kinds of, these same things going on even now today. And so, yeah, you need to know where your money is and make some sort of decisions about what kinds of industries that you want to have your 401k invested in. Absolutely.
There's the other subject when it comes to lending. You mentioned a lot of the limit your business cost and not spending too much, but I think it would be a good idea to also look at your personal life spending, because you're in a situation where your business is going to have to downsize, and a lot of these assets you purchase are not real assets. They're sitting in your personal life, like really fancy vehicles or leases on that end. It might be a good option to look into and see if that investment or expense in reality it's time to maybe not turn in that lease and not get it again. So I figured maybe I'd throw that in there as well too, is not only the business, but start looking into your personal life and see.
Yeah. Most of you out there probably have heard of the Millionaire Next Door. 2 books are written by Stanley and I can't remember the second guy. They're getting pretty old now. I think maybe 10 to 12 years old, 15 years old. Basically, I have seen in small business in my 30 years working with a broad range of them that the ones that were successful, that quote millionaires, the ones that were successful, boy, they really closely resembled the profile of the Millionaire Next Door profile. And of course, for those who aren't aware of that, that profile includes driving old cars, or at least driving a car that is way older than they could afford. Many of them, they're millionaires, but that doesn't mean that they go out and buy a new Mercedes because they think that they're rich. They're rich because they didn't go buy a new Mercedes. You can buy, if you're a millionaire, you can buy a Mercedes that would take 1/10 of your whole asset value, your equity today. That's not a good use of money. Of course, you might say, well, but I only put 10,000 down. Well, now you know $90,000 on the car. So that's not the way you get to be a millionaire. And we can look at any number of high-profile business people, and they tend to be much more careful with how they spend money than a lot of people who you would think would be a little smarter about it. One of the things they mentioned in there is that doctors, many times, because they don't think in this same business fashion, many times will have the same thing that someone who has 2 or 3 or 4 times the asset and they live exactly the same. The business guy's got $3 million. The doctor's got $1 million. They're both living exactly the same lifestyle. So that's kind of the way business people are. They're more conservative. The ones that survive are more conservative. So you see an event like this, and you know, it's horrible to think that we're going to lose millions of businesses. The truth is that that's what free enterprise is about. It's about weeding out the weak ones and keeping the strong ones. So when we talk about, and it's easy to say, well, the rich get richer and the poor get poorer. Well, what happens is that the ones who are not careful can get poorer, and the ones who have the money and have the wherewithal to, and the knowledge to conserve their money and invest their money in logical places, they're the ones that survive an event like this. And so, yes, and it's, you know, in my opinion, that's the way it's supposed to be. That's the way nature works. Nature, the survival of the fittest, allows the animal population to be as strong as possible. But when we sit back on our laurels and we don't have a recession for a long time, sometimes we have a lot of businesses that are pretty weak, and they take too much out of their business, and they're not conservative enough. And as a result, this happens and they go out of business. So as much as I feel for all of those people who are not going to make it, especially the brand new ones who didn't have a chance to establish themselves, this is the way of free enterprise. It is why the economy works so well, is because the ones who do a good job survive, the ones who do a poor job die. Sounds harsh, but that's nature is harsh. Nature is harsh.
If I were to go back to one of your graphs with all the faucets in the top and then the bucket in the bottom, and then you have the distributions to the owners. If you're aware of what a balance sheet and a profit loss statement is, you can see if you're bleeding your business yourself instead of the business not really being profitable. So maybe your business is very profitable, but you see wealth, you think it's wealth, but in reality, you're just leaking all that money into cash into the pockets of the owners, the salary of the distributions, and then they're appreciating non-deductible assets that are sitting in your driveway.
Yeah, you're absolutely right. There are also those who look at the income statement and they see that they made $200,000 last year, and now they're ready to go out and buy their Mercedes. The problem is that if you don't really understand your balance sheet, you don't realize that you maybe made $200,000, but you don't have $200,000. You've put your money into inventory and other assets, or you have large debts, and your equity, you could have made $200,000. Your equity might have been $50. Because you've got that many liabilities that still have to be taken care of. So it's your net worth that's important. It's not your profit. A lot of people do the same thing with their buckets, their bank account. They see a lot of money in the bank account and they think, well, I guess I can go spend some money and, you know, take clients out to dinner and really, you know, have a lot more fun than I have been. But the truth of the matter, it needs to be looked at a little deeper than that. If you owe a lot of money, you've got to use that money for something else. You can't just go spend it because it's in your bank account. So things can be elusive. Yes, you live or die based on cash, no doubt about that. But that's not the whole story. You have to also understand what your income is and what your equity is.
I know David. Oh, well, David's back. Let me see. Yeah, he's back. Let me add him in here. But there's a subject that I wanted to bring in when it comes to. It looks like we're leading the.
You've stalled out. I can't see you talking anymore. Something's happened. We lost the connection, maybe? Stand by, we're reconfiguring the network here. David, I think I can hear you now.
Okay, cool, man. I was just trying to reconnect to the last 5 minutes, and it looked like Edgar is having similar difficulties.
Yeah, he froze and then he went away, so it's you and I.
Awesome, nice, yeah.
Back in. Did you hear any of our conversation?
Yeah, actually, I got all the way up until you finished the slides, and then you guys got into that. And I know that where I got cut off was when Edgar wanted to bring me in for something, but I didn't know what that was or where that conversation was leading to. So,
Yeah.
so that's where I was. That's where I got left off. But this is the second time with Zoom. Maybe over bandwidth issues.
Could be. Yeah, could be. Well, he was about ready to ask you a question. I knew he wanted to get your opinion on that. We had just kind of had a discussion on the concept of being conservative in your cash use and making sure that you not only know what your cash balance is and your cash flow, but also your position in terms of equity and profit and loss, so that you can make the right decisions and not overspend. So Edgar's back now. Perfect.
I need to invest in a new asset. Looks like my computer froze on me, and I have to restart it real quick.
So I just mentioned to Dave that you were just about ready to ask him a question. I tried to bring him up to speed. So.
Yeah, the question, actually a comment open for discussion. Some of the biggest business, business reason why we failed that I met that was really common. And I got to meet a lot of clients that were in rough business position. And when I started talking to them, getting to know what was it that was really hurting their business, what I found out is they got themselves in a really bad loan. These things were probably, they didn't even know it, but they were probably close to 50 to almost 100% APR interest rate because they were just shark loans. They bought a truck for $15,000, ended up purchasing it in reality for like $30,000.
Yeah.
So the fact that these predatory loans, if we were to call them there, if they were used properly, maybe they were not predatory loans, but these loans are the ones that could potentially also bleed out an entire business from ever even really having a chance. And so now with what's going on, the reason I brought this up is because I kind of have a feeling that all the guidelines of a typical loan, equipment loan with business, line of credit with business, are not going to be that easy anymore to potentially get until kind of even the bank feels a little more comfortable saying, wait, are you really one of those businesses that survive? We're going to wait maybe a year before we have taxes. We're going to maybe wait because what was a loan that was a person that qualified for a loan easily, they might not do it anymore. And so are people going to be faced in such a scenario where like, I'm getting that loan because I have no choice. And if you are doing those type of choices, make sure at least you figured out every other option. That's why I wanted to bring David up to speed on this, because that would be an awesome topic of conversation, because it includes lending, injecting into your cash flow, and figuring out when, using the break even and the cash flow forecasting to know if you should indeed take this loan, if it's going to survive or not, and maybe some of the other options are out there.
Certainly, yeah, certainly understand the cost of the various opportunities. I'll just throw in real quick so David can answer. Believe it or not, I still hardly believe it. I had clients once who had been in business for 30 years, and as I began to work with them, I discovered that they had sold their receivables to kind of like a hard money lender, and their interest rate was $30,000 a month. That was the extra interest that they were paying on that. But they had gotten themselves in a spot where nobody else would lend them money. And they felt like they had to, and perhaps they did. But, we immediately said, we got to refinance this. There has got to be somebody out there that will take this loan out. So if we can simply break it, bring it down 3 or 4 or 5 points, we can save a lot of money. Well, it turned out we literally were able to cut the interest in half. That's how much they were paying for this hard money loan. Somebody had just taken them for a ride.
David, do you have any, I know factoring is huge when it comes to the trucking industry. Their receivables are really easy to kind of put liens on and collect from the individual paying. And it's a very common type of way. And it's a really unique way of lending, because in reality, you're not really paying a monthly fee. You're just getting your loans in advance, but you're losing 1 to 3% out of your cash flow. And if you look at it that way, if you start calculating it, that could be a 30% interest rate if you calculate an APR versus having a line of credit. And so they might be disguised as a tool. But if you don't qualify for the line of credit and you need the cash now, of course that makes sense. But factoring, it's a great tool I've seen being used before, in addition to potentially the option B first instead of C, which would be like a line of credit. That's an example of maybe planning proactively through the lending side if you are going to be short in cash, from finding a way to not just leak all your cash thinking you have no options. That's the only option you have.
Agree.
Oh, you know what? David I have him under, he can't talk. Let me bring him on as a panelist, promote to panelist.
I was talking to him for a minute.
I don't know what happened. Maybe when I joined. Let's see if he's on there. David?
There you are. Hey.
There we are. Apologize for that.
No problem, man. So wait, do you have, okay, we got the video.
All right.
Well, yeah, so interesting points that you brought up. And I think the challenge is going to be how a business is going to, well, from an underwriting standpoint, you're obviously looking at the last few months trending income to make sure that, there's a positive trend coming upwards. And as these businesses are closed, you got 2 months, 3 months. And as Ron had mentioned, the recovery is going to be a lot slower than what most people think. So you may have 4, 5, 6 months of no positive income, enough for a bank or a lender to decide whether or not you're healthy and stable enough to even be a borrower. So I think it's important to take that look right now. And a lot of times when, like you talked about, these predatory loans and these merchant cash advances is pretty much, they're disguised as such. These things bleed cash daily, and it's almost like factoring, in a sense of, you're taking the funding now for the lender to come in and pay your debts off, basically taking over the payouts. So in the merchant cash advance, it basically, you're promising them future credit card sales, and some of them imply that you have to use their own processing machines as well. So there's control and there's a lockbox at the bank to where everything comes in from the top, and that loan is the first and foremost transaction that comes out, and then the business sees any excess cash flow out of that. So and these things are at daily rates, and it may appear to be a life raft in some instances to where you could apply for and get qualified for some of that. But just judging by those reopening strategies and what your future cash flow may look like, you just may be acquiring debt, and you're just going to continue going down downward spiral to where you're not going to be able to recover from that. So it's important to understand what that use of funds is going to be, and have an exit strategy for it, and whether or not it's even worth taking that debt on, because you're going to have to personally guarantee that loan. And if you don't have a business after that loan, and you're just taking excess money and you're digging a ditch that you're not going to be able to get out, that's a pretty big mirror to look at to find out whether or not you're going to exist and whether or not this loan is even going to help, and even if you're going to qualify for it. So
I got a question, and maybe even Ron can jump on this, but very few non-owner guarantee loans do I get to see out there. Maybe I've seen people get pretty creative with their thesis to make sure after a certain period of time, the owner guarantee drops off and the corporation takes over. But with the big banks, it's almost automatic. You're going to have a owner guaranteed. But when it comes to non-traditional lending, you kind of do have at least that advantage that you might jump into situations where they might just put a lien on your receivables, and not you as an owner. Or is it still pretty common that most of these other type of lending still require a guarantor to be part of it?
yeah, well, just put yourself in that lending shoes in this environment, and that's the way I always look at things, and whether or not it's a common sense approach is if that business is drowning, or is it uncertain? They may have, some cash flows to support the loan, but I'm going to be extra cautious on my underwriting to determine whether or not that industry is still even existing. So I'm going to take any collateral that I can to secure my position. And it's either equipment, secondary real estate, or, their personal residence at times where it's leveraged to, fund the business. And that's, again, where we got to take a look and figure out if that debt's even worth incurring to figure out if that business is going to be alive, after that loan. So yeah, you're going to be looking at some type of a collateral pledge, if it's not real estate alone, but it's difficult to get unsecured financing regardless. A lot of times, where there's, uncertainty in the markets, banks typically will cut your line of credit without even, you find out, the next day when you're trying to make a purchase and your line of credit has been cut. So, there's a lot of conservative underwriting right now, and it is starting to, I've noticed some lenders are starting to at least pop back into and saying, hey, we're back, we're lending. But I've noticed obviously those conservative underwriting just to, secure their position, because, it's money that they're lending off that, that's the goal of it is to get that money back and payable in interest. And, if that business, a lot of them, are, I can imagine the underwriting is a lot of that going on with the forecasting of whether or not that industry and this business is going to survive. So who knows what's going to happen with, defaulted loans that are being made now and in the next 2-3 months for businesses that may not be around.
Yeah, it makes a lot of sense. The expertise, I can kind of just tell you as a borrower that I haven't been able to really borrow anything significantly without a personal guarantee or real estate for about 25 years. So, when I was first in business, I got an SBA loan and had a good banking relationship, paid that off, and the bank was willing to give me, kind of a small revolving account and that sort of thing. But that, times are a lot different, and there was a lot of water that had gone under the bridge, and they saw me grow from 1 to 7 stores, and they saw my inventory increasing all the time, which they saw as an asset. That they were completely wrong about that, because fashion inventory is not an asset. For more than it's an asset the way a ripe banana is an asset. It's not an asset for very long. And but yeah, I think it has completely changed, as you say, David, that the underwriting is tougher. It needs to be tougher. And I think, and just to throw a comment out, I think it has to do with the bankers no longer having personal relationships with the borrowers. It used to be, they have to package it, they want to sell it. They're looking at real numbers now that don't have much to do with potential. So I was able to sit down with a banker. They had 2 branches. I was important to them because as a retailer, I was running lots of cash through the bank. And they saw me as somebody who was honest and was going to pay them back and that sort of thing and worked hard. That doesn't happen, anymore. Yes, if you've got a big business doing millions of dollars every year, you can have a banker come over and sit down in your office to see what's going on. But I don't know. I think the underwriting has changed a whole lot. They need a lot more. And I'm not sure that's wrong. I think that too many bankers got burned too many times. So
Yeah, and I think we might have lost David if he jumps back in. Perfect, but there he is.
he's moving again.
Yeah, I'm back. Yeah, it's very unstable, But
Yeah,
yeah,
When your fan stops, we know something's wrong, David.
yeah. Hopefully, I'm glad it's just the internet and not the power.
yeah,
Yeah, all good points though. And I think one of the things that I noticed as a startup, and what we were putting projections together to start a fitness sports facility, and glad that didn't happen. You got blessings in disguise, but I think with sitting in that position and putting myself into whether or not I had that operating and what type of debt that I would incur, kind of run scenarios through to figure out how I would have survived and how I would be impacted in something like this. And SBA loans, you got a lot of it. There's goods and bads, obviously. Everybody always is running because of the amount of documentation that is required for these. And a good broker would be able to shave that off and help to, guide them in the right direction. But the relief that you get from an impact on this pandemic, or if there's another natural disaster or, economic disaster for things that are unforeseen that the government deems so, I think that's the only safe loan that in this case, it exactly goes back to what you mentioned is who owns that paper. And if it's going on Wall Street, then, you're right. These banks are packaging loans and underwriting them to the guidelines of the investors of Wall Street, where you got local community banks that are maybe have a certain amount of money that has to be distributed into the community. And they're the ones that are going to be developing those relationships and making a little bit more of an aggressive approach if they like that business and they have a history of deposits there. So I've seen a lot of just in the group and in a lot of these people, coming out of Chase and Wells Fargo and Bank of America and starting relationships with these smaller local community banks that I think is a fabulous idea to start, because you can get lines of credit and you can get funding that is not underwritten to the guidelines of an investor like Wall Street. But the SBA in itself right now, you get a loan. If you fund a loan right now, 6 months to a year of payment deferments, and that's not interest bearing, and it's basically just free payments for that. So it's good to know that if we were to get into that business, an SBA loan would have really gave us that relief to cover. So it makes me start to think about the importance of that loan for small businesses that it used to, and I still think it does leverage up to 90% if you include real estate. So so I think the risk in running into some type of pandemic, national disaster, or economic disaster, having an SBA loan, it doesn't seem like a bad idea.
Yeah, what do you say to a company that just feels like it's too cumbersome to get the numbers together? It takes months and months in order for work with the banker, get it approved by SBA. How do you help the business that is just so shy about numbers and they could what a terrific opportunity to have your interest deferred for a year. Oh man, I'd love something like that. So, how do we help businesses understand that and then help them actually get the loan?
yeah.
Bankers and brokers that service these SBA loans are going to have a little bit more processing, be more intensive on the processing side to help package and project these loans, because they're, I think that they're going to be, again, trying to account for the gap in income that is lost, during this pandemic and, going through. So it's going to be difficult to get anything approved unless you've been an essential and never stop. And that's the case, then, by any means, that the SBA loan is definitely going to be a win-win for that business. But for the underwriting of a loan that is in a business that is uncertain, we're going back to that same question about whether or not that, and is this cash flow going to last, or is it even going to cover the debt? So, you got to look back at your, take an inventory of your assets and, see what equipment could be leveraged. If you have equity in real estate, that could be leveraged. And if you still have credit that you're able to get unsecured business credit from. So it's just basically taking an inventory of what you have and hopefully getting yourself educated, or get with a banker or broker to find out what your best options are, instead of taking, the carrot that is dangled in your face when you're logging on the internet and you got $150,000 cash, get it in 5 days, and next thing you know, you're sunk. So it's interesting. It's going to get interesting, but I think the SBA has been traditionally at one of the most productive and revenue-based loans that we've originated, and I think it's not going to change. It's actually going to increase for the demand of these loans as these Wall Street starts to get more conservative, while hopefully the government still has money to fund after all of these PPP loans. But yes, I think it'll be interesting, definitely.
Yeah, well, we're at 3 o'clock already. Here, I'm gonna mute your line, David, real quick. Gives me a lot of feedback. All right, we're at 3 o'clock, 3:07. There's a couple subjects for next week that maybe we can see if we could start putting on a panel for the, we mentioned potentially getting a panel for disasters. I think it was pretty good. With
disruption of all kinds and COVID specifically, yeah.
And then also been trying to consider maybe putting a panel of just different type of lenders. That would be really interesting to see that, especially as it came fresh off the big banks lending strategies, and basically a lot of, we hosted a seminar like this live last year at the women, what do you call it, CDCs, Accion, all the, what else do we have in there? All the federal indirect money nonprofit organizations that do SBA loans, AMPAC, some of these guys in there, and they offer SBA lending, but as well as the SBA lending through the broker side. So that'd be an interesting subject to go into depth and bring that conversation up. What do you think, David?
I think. Are you there?
Yeah, there you go.
Yeah, definitely. Whenever you're ready, we can definitely get some lenders on here. I think that'll be helpful for at least people to understand their borrowing power before they go out and walk into their bank, just to know the language. And it's always good to have a second opinion, but I think it's crucial if you get denied from your bank to understand what options are out there, because you can really start searching the internet and next thing you know, you're taking something that you think is the lifesaver, and you're not reading the fine print. You don't understand the financing, and you don't understand the collateral behind it. So helps get somebody to help you find your assets and what's available to you and your best option.
Yeah.
Awesome. Any closing remarks, Ron?
No, I think we've covered that. It's good to have gone sort of started with the PPP. That's been an interesting ride for all of us. Of course, it's not done. But then what it does is it feels to me like it opens up the whole new issue of borrowing as a business. I'll never forget, as a young man, I took a seminar, one of the really good seminars that I ever had. It was called The Care and Feeding of Your Banker. And basically what it was about is, look, you know, your banker speaks a certain language. He wants to see you speak a certain language. He wants to look at certain things a certain way. And so you want to just submit to it and give it to him so that he can have the tools he needs to help you. Because if you don't do that, you're going to find yourself in a problem. And I found that to basically be true.
Yeah, there's a lot I can add to that, even working with the big banks. But overall, the thing it comes down to is I always mention this to anybody: shop your banker, shop your bank, find out who you want to work with, get to know them. Low level, small business, startup, or a big business. There's always a banker out there you might want to work with that you guys can work together to grow together. And it could be at a local bank, it could be at one of the big guys as well too. But you do have to have some sort of relationship with somebody in your depository bank, lending bank, so they can pay you on those process. But we'll wrap it up with that. Next week we'll try to get the panel prior to the day of the presentation. We'll try to kind of plan and see if we can get it out there for everybody to register before then and go from there. But I think we're pretty much good to go. And Connie just says thank you for everything, and we'll see each other next week, and we'll go from there.
Sounds good.
All right. Thank you so much. Thank you, David, for joining us today.
All right. See you guys. Bye, Ron. See you next week.
Bye.